40%. That's what the IRS can take away from your grandkids if you don't understand what I'm about to tell you. You're out here holding through bear markets, sitting through downturns that would make most people on Wall Street feel physically ill, and studying long-term utility while everyone else is chasing meme coins. You're playing the long game, and the entire time, someone's waiting at the finish line. The US Treasury and the IRS. Most people think estate planning means writing a will and handing it to your lawyer. And that's cute, but it only works if your assets aren't going to change much. But if you're holding crypto assets that could appreciate 10, 20, 50, 100 times over your lifetime, a basic will is financial malpractice. And if you want to learn how to do it the right way, stick around. That's what we're going to talk about in this video. Before I get into it, nothing here is financial advice, only for entertainment educational purposes. Please always speak with a financial professional, someone that's licensed as a CPA or an attorney before making any tax, legal, or financial decisions. This is just my interpretation of some information that's out there, and hopefully it'll be educational for you to make sure you ask the right questions when speaking with those professionals. So here's what happens. The government taxes wealth every time it passes down a generation. You die, estate tax. Your kids die, estate tax. Grandchildren pass away, estate tax. And I know this sounds morbid, but it's important. That's how generational wealth quietly disappears. So people think they've found a workaround. What if I just skip my kids and leave everything directly to my grandkids? The IRS has already thought of that, and they've created something called the generational skipping tax transfer. It's a flat 40% tax. It can be applied on top of the estate or gift tax if you don't structure things correctly. In some cases, more than half of what you've built never even makes it to the next generation. If you build $10 million, your grandkids might only see $4 million or less of that. And no, that's not just a billionaire's problem. In 2026, every individual has roughly $15 million worth of lifetime gift tax exemption. And if you're married, you have about $30 million between you and your spouse. The generational skipping tax transfer exemption is equal to that amount. But here's the part most people miss. You don't automatically get this protection. You have to use it. Once the laws change, which can happen at any time, whatever you didn't lock in is gone forever. So waiting could cost you tax-free capacity that you're never going to get back. Now, let's simplify how this actually works. The IRS wants to tax wealth at every single generation. A generational skipping trust is designed to legally bypass one or more of those generations. Think of wealth like water moving through buckets. Normally, it would flow grandparents to the child or your kids and then to the grandchildren. And every time it moves, the IRS takes a scoop or a piece of that water. A generational skipping trust installs pipes directly between the first and third bucket. And your kids can still benefit. They can receive income and they can get access to use the assets, but they never actually own them. And when they die, nothing transfers, because nothing ever belonged to them. The assets stay inside the trust and continue on to the next generation. For crypto holders, this is especially important for cold storage for generational wealth outside your children's taxable estate. But you can't just dump unlimited amounts of assets into these trusts. You have a lifetime exemption. Think of it like a one-time coupon. If you allocate the exemption when you fund the trust, something very powerful happens. The value is locked at today's numbers. You could pass $10 million of crypto into a GST exempt trust today. If that grows to $500 million over the next 40 years, the IRS doesn't get estate tax on that growth ever. And that's why timing matters so much with appreciating assets. Now let's talk about the 3 ways that people accidentally trigger that 40% tax. Number 1, direct skip. Your assets transfer directly to your grandchildren. If you didn't properly allocate the GST exemption, that transfer, it's going to trigger a 40% tax immediately. And here's the painful part. The person making the gift pays it. You gave money away and write a massive check to the IRS at the same time. Number 2, taxable termination. This is one of the blind spots a lot of people have. When you set up a trust for your child, they receive income for decades. Then they pass away and the trust moves to your grandkids. If the GST exemption wasn't allocated when the trust was created, guess what? That moment also triggers a 40% tax on the entire trust. Not the original amount, the full amount, even after the decades of growth, and that all could be wiped out just because you didn't do it right up front. Number 3, taxable distribution. This happens when the trust makes a direct payment to a skip person, like a grandchild. If the trust isn't GST exempt, the recipient owes those taxes. Imagine sending your grandkid some money for college and accidentally handing him a tax bill alongside it. That's not legacy, it's negligence. So how do you do it correctly? Well, a lot of people will use a dynasty trust. Most states have an old rule that forces trust to end after a certain period, pushing assets back into taxable estates. But there are some states that have realized that this is a bad policy. States like South Dakota, Nevada, Delaware and Wyoming have trusts that last for hundreds of years, sometimes indefinitely. And when you combine a dynasty trust with the proper GST exemption, you create something very powerful. Your crypto sits inside that trust. One generation uses the income, the next generation uses the income, and the principal keeps compounding. These trusts are also protected from estate taxes, creditors, divorces, and other bad decisions for generations. But this only works if the trust can adapt. That's why you need something called a trust protector, someone with the authority to modify the trust as laws change. Because locking wealth into a rigid structure for 100 years is like deploying a smart contract with no upgrade path if there's a bug. One bug could wreck everything. And there's also an advanced strategy for married couples called reverse QTIP election. This is a qualified terminal interest property. And when you do it in reverse, it's really powerful. It allows couples to use a marital deduction, lock in the GST exemption right now, and maximize how much wealth is protected across generations. It's one of the most powerful and most misunderstood tools in multi-generational planning. Building wealth is hard. Keeping it across generations is harder. The system is designed to slowly drain capital every time it passes down the family line. You're already long-term thinking with your assets. Make sure your legal structure is just as long-term thinking. Check with state laws, understand the exemption window, and stop thinking in years. Start thinking in decades or centuries. You have to build your wealth first, but that's only half the equation. Protecting it over the long term is the other piece. So get your bag right, and then get your trust right. So let me know what you think. Have you seen other trusts out there that you want to use or have thought about using? Please like, subscribe, hit the notification bell, and let me know in the comments below what you plan to do for your family in order to be able to mitigate taxes over generations. And we'll see you on the next one.